Hello and welcome to the first review of 2013. I'd just like to start the review by wishing everybody a happy and prosperous 2013. Our new office in Salisbury is now running smoothly, and I'm pleased to confirm that all of our advisors meet the new Financial Services Authority standards for providing independent financial advice and are all in possession of their statements of professional standing. New regime I'd be grateful if you could take a moment to read our new terms of business. The link on this page will direct you to our webpage for this. And if you've got any questions, please feel free to call us. Obviously, you won't be charged despite anything that you might be reading in the press. Just to look quickly at 2012 events, the year was dominated by three main areas. In the States, the fiscal cliff, where tax increases and spending cuts threatened to send the US economy back into recession, was a major overbearing factor. A last-minute deal avoided this, but raising the debt ceiling is the next issue for 2013. Reflecting on the Eurozone, the big question was, would the Euro survive? Greece did not leave the Euro in 2012, and the Eurozone remained intact with promises from the ECB, the European Central Bank, to do whatever it takes to support the Euro. And reflecting on the Far East, particularly China, the impact on the global economy if the slowdown continued, well, there are signs that growth is accelerating again, following some positive growth indicators toward the end of 2012. Obviously, we need to give some consideration to the economic outlook for 2013, and the new year brought with it some signs of hope for Europe and the United States, although there is much to be done to address the continuing issues that we've spoken of so often in these areas. As we predicted last year, the FTSE 100 did break through the 6,000 point mark and is currently maintaining that position. In the United States, the deal reached at the 11th hour to avoid the US fiscal cliff raises tax for the wealthiest Americans and delays spending cuts for another 2 months. This means that the Bush tax cuts have now become permanent for all but the wealthiest 2% of Americans. Raising the US debt ceiling will be the next topic for discussion and is crucial to any recovery there. Because it's still the world's largest importer, a weakened US economy and any fall in demand would have had a knock-on effect on the rest of the world. In the Eurozone, as we mentioned earlier, Greece did not leave the Euro in 2012 and the Eurozone survived completely intact. Europe's leaders' commitment to defend the Euro and actions such as reduction in borrowing costs of countries like Spain and Italy provided a boost in confidence on a worldwide basis. Obviously, the austerity measures are very unpopular, and there continues to be resistance to them across Europe. Therefore, economic growth as a result of these measures needs to be evidence to sustain support and maintain market confidence. A positive step is the supervision of the Eurozone's big banks by the ECB, European Central Bank, intended to be implemented in 2014. Once this is in place, any troubled banks should be able to apply directly to the European Stability Mechanism, known as the ESM, which is a permanent bailout fund, rather than relying on government funding that increases the country's debts. If we think about Asia, it's projected to remain the global growth leader during 2013, expanding by over 2 percentage points faster than the worldwide average. Concerns over the slowdown in growth in China have now eased, with economic growth stabilizing and growth levels expected to continue to increase steadily, but obviously not at the past very high rates. This will benefit commodity markets and consumer sectors as the government steers the economy toward household consumption. The other BRICS countries, Brazil, Russia, India, South Africa, should see continuing growth in 2013, although real GDP growth has been slowing since 2010. Textbook and historical strategies have advised investors to diversify their portfolios to spread risk to maximize investment returns. One of the obvious benefits of diversification was that many areas were negatively correlated. So, for example, investing in the shares of an ice cream company and an umbrella company would see returns on sunny and rainy days, thus spreading the risk. Similarly, investing in developed markets and emerging markets where risks in one part of the world would not affect others also provided some diversification. Globalization of economies, including supply chains, capital and labour flows, and financial markets, has led to much closer global and asset correlation, making true diversification now much more difficult to achieve. We endeavour to build our portfolios for investors that spread risk and generate returns that justify those risks. For the coming year, further volatility is expected as the economic crisis continues onward into this new territory. So this slide is a chart, and the comments for that follow on the next slide. So, referring to the charts on the previous page, this encompasses the past 12 months of performance for the FTSE 100, the S&P 500 developed economies, and the MSCI emerging markets indices to demonstrate the previous comments about the effects of globalization and how the developed and emerging markets are now moving so much more closely together. To bring matters to a summary, a negative real return on risk-free assets such as cash and gilts is likely to continue through 2013. There is now thought that interest rates in the UK will stay at 0.5% until 2017, so it means that investing in cash for the next 4 years will almost certainly result in its real value eroding fairly significantly. Despite weak global growth in 2012, risk-based assets performed well, with global equities and corporate bond markets outperforming the risk-free asset classes. To achieve potential returns beyond inflation for 2013, it will mean remaining invested in a diverse portfolio of equities and fixed income instruments like corporate bonds. I think the volatility will continue, therefore anyone invested directly in the markets or via the type of portfolios that we construct is still going to experience ups and downs for the foreseeable future. But we do hope that our risk-rated risk investment portfolio strategies will continue to provide our clients with a less bumpy ride. We will obviously continue to keep abreast of affairs, but in the interim, if you would like to contact us, please do feel free to do so at any time. Rest assured, no special charges apply because it's all part of our service to you. As is usual, our contact details follow on the next page. Thank you very much for listening.